So we're going to talk about cash versus accrual basis accounting. And that requires us to separate out when the revenue and expense should be recorded from when the cash gets exchanged. Cash can happen before, at the same time, or after revenues and expenses. And this is the key to accrual basis accounting. For customers, they can pay you before, at the same time, or after you perform the service or deliver the goods. For vendors and employees, you can pay them before they perform the service for you or you use up the thing, at the same time, or after. Let's have a look at some examples. If a customer pays before they get the thing, you record the cash and you record unearned revenue. Unearned revenue is an obligation. It's a liability. It means you've got the cash and you have to either perform the service, deliver the goods, or give the money back. So when you have customers paying in advance, it shows up in the cash flow statement because you have the cash. But it doesn't show up in the income statement until you either deliver the goods or perform the service. So later, when you deliver the goods or perform the service, you would clear out the unearned revenue because now it's earned and you would record it in revenue. At that time, it's going to show up on the income statement. Sometimes customers pay you exactly when they come to pick up the goods, like in the grocery line. The customer pays exactly when they get their groceries. And so it shows up on the cash flow statement and the income statement at the same time, and there's no later entry needed because the transaction is complete. The earning is complete and the cash exchange is done. Some businesses allow customers to come get the stuff, or they provide services and they give them some time to pay. They do it on credit. And so they record the obligation for the customers to pay them because they've already shipped the goods or they've already done the service. So it shows up in the income statement first because they've already earned it, but the cash hasn't been exchanged yet. That happens later. When it happens later, you clear out accounts receivable and record the cash. Let's try the same logic for vendors and employees. When you pay a vendor, let's say State Farm, for the insurance policy for the year, you record that you've prepaid the insurance policy when you write the check. But you don't record the expense until it's used up, until that month has expired. If you cancel the policy in the middle, you notify State Farm, they'll give you your cash back. So until it's used up, it is still a prepaid asset. So it's going to show up on the cash flow statement because the check's been written, but it's not going to show up on the income statement until the months start to expire and you have the insurance expense and the prepaid is reduced by the amount that was expired. Sometimes you go and pay for the expense when it occurs. So you may go check into a hotel and spend the night and pay with cash. So you have travel expense and the payment happening at the same time. There's no delay. It will show up on the cash flow statement and the income statement at the same time. No later entries needed. Sometimes you pay for it after you've gotten it or after the service has been rendered, such as when employees come and work for you. Often they will come and work for weeks and then they turn in a time card and then you pay them another week or two later. So you have the salary expense when they work and the obligation to pay them, but the actual payment comes later. So you record the salary expense when they work, and then later on when you pay, you clear out the obligation account, the accounts payable, and you write the check. So it's going to show up on the income statement when the work is rendered and the cash flow statement later when the payment is made. So there are 6 basic types of transactions with customers. You can collect before you earn it, when you earn it, or after you earn it. With expenses, vendors and employees, you can pay before you use it up, when you use it up, or after you use it up. So those are the 6 themes, and you can think about when you are journalizing transactions that you're fitting into one of these. Notice that in these two corners are classic journal entries. Here is accruing revenue that's been earned but not collected. Here is reversing unearned as it's earned. Here is accruing an expense when you know something's been used up and you haven't paid for it yet. And here is reducing the prepaid and recording expense for prepaids that are expired.